Welcome back to the channel, and if you're finding value in this deep dive into the silver market, make sure to hit that like button, share this video with anyone interested in precious metals investing, and drop a comment below telling me what aspect of the silver market you'd like me to cover next. Your engagement helps this content reach more investors who need to understand what's happening right now in these critical markets. And stick around until the end because I'll be revealing what's coming in our next video that could completely change how you think about portfolio allocation in 2026. The precious metals market is experiencing something that only happens once or twice in a generation, and most investors are completely missing it. Right now, as we speak in February 2026, silver is outperforming gold at a rate that hasn't been seen in over a decade, and the mathematical relationship between these two monetary metals is telling us a story that's worth paying very close attention to. This isn't about hype or speculation. This is about cold, hard numbers and historical patterns that have played out repeatedly over centuries of trading data. Let me take you back to April 2025. At that point, you could buy 1 ounce of gold and exchange it for more than 100 ounces of silver. That's right, the gold to silver ratio had climbed above 100 to 1. To put this in perspective, this meant that silver was historically cheap relative to gold, sitting at a valuation extreme that had only been reached a handful of times in modern market history. When you see ratios spike above 80 to 1, you're looking at silver being severely undervalued compared to its sister metal. At 100 to 1, we were witnessing something remarkable. A dislocation that was sitting more than 2 standard deviations above the long-term average. Now fast forward just 9 months. As we entered 2026, that ratio had compressed dramatically to roughly 57 to 1. Think about what that means mathematically. Gold gained an impressive 67% during 2025, which by itself would be considered an extraordinary year for the yellow metal. But silver absolutely exploded, surging 147% in the same time frame. This wasn't a small move or a temporary spike. This was a fundamental repricing of silver relative to gold, driven by forces that are still in motion today. By late January and early February 2026, the gold to silver ratio fell below 50 for the first time since March 2012. Let that sink in. Silver's relative strength has reached its highest level in nearly 14 years. We're not talking about a minor adjustment here. We're witnessing a historic mean reversion that's been building pressure for years, and it's now releasing that energy into the market with tremendous force. Understanding why this matters requires looking at the long-term historical relationship between these two metals. Over centuries of recorded trading, gold and silver have maintained a relatively stable relationship to each other. The long-term average ratio tends to hover somewhere in the range of 55 to 65 to 1, though this has varied significantly depending on the era and the monetary system in place. During periods when both metals served as official currency, the ratio was often fixed by governments at levels as low as 15 to 1 or 20 to 1. In the modern era of floating exchange rates and industrial demand for silver, the ratio has been more volatile, but it has consistently demonstrated a tendency to revert to its mean after reaching extremes. What we saw in April 2025 was one of those extremes. When the ratio rises above 80 to 1, and especially when it crosses 100 to 1, history shows us that silver tends to be severely undervalued relative to gold. What typically follows these extreme readings is a powerful mean reversion, where silver dramatically outperforms gold and the ratio falls sharply. This isn't mysticism or market superstition. It's a pattern that has repeated itself through multiple market cycles, because the fundamental factors that drive both metals eventually reassert themselves. Consider what happened after previous ratio spikes. In March 2020, when pandemic panic gripped global markets, the gold to silver ratio spiked to an all-time high of 125 to 1. What followed was a ferocious silver rally that compressed the ratio back down to around 70 to 1 within just 5 months. Silver nearly doubled in that time frame, while gold posted solid but more modest gains. The pattern is consistent. Extreme ratio readings don't persist because the market forces that create them are temporary, while the underlying supply and demand fundamentals eventually overwhelm the fear or speculation that drove the dislocation. So where are we now, and where might we be heading? Current projections from market observers vary depending on their assumptions about gold and silver price trajectories, but there's a general consensus forming around several scenarios. Conservative estimates suggest the ratio could drift down to 75 to 1 by the end of 2026. Base case forecasts point to a fall to 70 to 1. More optimistic scenarios envision compression to 65 to 1 or below if silver experiences another surge similar to what we saw in late 2025 and early 2026. But here's where it gets really interesting. If we look at historically observed extremes in the other direction, during periods when silver dramatically outperforms, the ratio has fallen to levels between 15 to 1 and 20 to 1. Now, I'm not suggesting we're necessarily heading back to those levels, which were largely artifacts of bimetallic monetary systems and different industrial demand structures. However, Even a move toward the lower end of the modern trading range would have profound implications for silver prices. Let's do some math to illustrate this. As of mid-February 2026, gold is trading in the range of $5,000 per ounce, having made substantial gains from its previous ranges. At the current ratio of approximately 57 to 1, that puts silver at around $87 to $90 per ounce, which is roughly where we're seeing spot prices trade after the recent correction from the January highs. Now, if the ratio compresses further to 50 to 1 and gold remains at $5,000, silver would need to trade at $100 per ounce. If gold continues its own bull market and reaches $5,500 while the ratio compresses to 50 to 1, you're looking at silver at $110 per ounce. But let's consider a more dramatic scenario, not because it's guaranteed, but because it's within the realm of historical precedent. If the gold to silver ratio were to compress toward the extreme levels of 15 to 1 or 20 to 1 that have been observed in the past, even reaching 30 to 1 would put silver at $167 per ounce, with gold at $5,000. At 20 to 1, you're looking at $250 per ounce. These aren't fantasies pulled from thin air. These are mathematical outcomes based on ratio levels that have actually occurred in precious metals markets during previous cycles. The question every investor should be asking is what drives these ratio compressions, and is there reason to believe this move has further to run? The answer lies in understanding the fundamental differences between gold and silver and how those differences play out in various market environments. Gold is primarily a monetary metal and a store of value. Yes, it has industrial applications, but the vast majority of gold demand comes from investment, central bank reserves, and jewelry that also serves an investment function. Gold's price is largely driven by monetary factors like real interest rates, currency devaluation concerns, geopolitical risk, and inflation expectations. Silver, by contrast, is a hybrid. It's both a monetary metal with a long history as currency and store of value, and it's an industrial commodity with critical applications across dozens of sectors. Roughly half of silver demand comes from industrial fabrication, including electronics, solar panels, electric vehicles, medical applications, water purification, and increasingly advanced technology infrastructure like data centers and artificial intelligence computing. The other half comes from investment demand and jewelry. This dual nature creates interesting dynamics. During economic downturns and financial crises, gold tends to outperform silver because investors flock to the purest store of value, and industrial demand for silver weakens. This is what drives the ratio higher during periods of economic stress. We saw this in 2008 during the financial crisis, in 2020 during the pandemic panic, and again in early 2025 when concerns about global economic stability were elevated. But during economic expansions, periods of monetary inflation, and especially during technological build-outs that require massive amounts of industrial metals, silver tends to outperform gold significantly because it benefits from both its monetary premium and its industrial demand. What we're experiencing now in early 2026 is the latter scenario playing out with unusual intensity. The global economy has proven more resilient than many feared. More importantly, we're in the midst of multiple technological transitions that are extraordinarily silver-intensive. The solar energy build-out alone is consuming unprecedented quantities of silver. A single solar panel uses approximately 20 grams of silver, and global solar installations are running at record levels. By current estimates, the photovoltaic sector is consuming somewhere between 120 and 125 million ounces of silver annually, and that number is expected to grow substantially as countries accelerate their renewable energy transitions. Electric vehicle production is another major driver. Each EV uses approximately 50 grams of silver, roughly twice what a traditional internal combustion engine vehicle requires. As EV production scales up globally, with projections suggesting 14 to 15 million units in 2026 alone, that sector is adding another 70 to 75 million ounces of annual demand. And that's before considering the charging infrastructure, grid upgrades, and battery production facilities that also require significant silver content. Then there's the artificial intelligence and data center boom, which is consuming silver in ways that most market participants haven't fully appreciated. The power density required for AI computing, the advanced cooling systems, the high-performance printed circuit boards, the massive backup power systems, all of these require substantial silver content. When you combine the direct silver usage in data center equipment with the solar arrays being built to power them, you're looking at a demand driver that's structural and growing exponentially. All of this industrial demand is hitting a market that's been in supply deficit for 6 consecutive years. Mine production peaked back in 2016 at approximately 900 million ounces and has fallen to an estimated 835 million ounces in 2025. Despite silver prices rising dramatically, mine supply hasn't responded, and there are fundamental reasons why it can't respond quickly. About 71% of mined silver comes as a byproduct from gold, copper, lead, and zinc operations. This means higher silver prices don't automatically incentivize more production, because mining companies are making decisions based on the economics of the primary metal they're extracting. Even for primary silver mines, the timeline from discovery to production is extremely long, typically 15 to 18 years, and the capital costs are enormous, often exceeding $500 million for major projects. This means that even with silver at current elevated prices, the supply response is going to be minimal for years to come. Meanwhile, demand continues to accelerate, particularly from these structural industrial drivers that aren't going away regardless of economic cycles. This is why the gold to silver ratio compression we're witnessing isn't just a temporary trading phenomenon. It's a repricing based on fundamental supply and demand reality. Silver was genuinely undervalued at 100 to 1 relative to gold because the market wasn't fully appreciating the supply constraints and demand acceleration that we're building. As these realities became impossible to ignore through late 2025 and into 2026, the ratio began correcting violently. The compression from 100 to 1 down to 57 to 1 represented silver gaining roughly 75% relative to gold in less than a year. That's an enormous move, and it's left some market participants wondering if the adjustment is complete or overdone. The evidence suggests it's not. At 57 to 1, we're still above the long-term historical average. More importantly, the fundamental drivers that sparked this move are not only intact, but intensifying. Consider the inventory situation at major exchanges and vaults. Registered silver inventories available for delivery at COMEX have declined approximately 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories are at decade lows. This is happening while open interest in futures contracts remains elevated, creating a situation where the amount of silver promised on paper far exceeds the physical metal available for delivery. When you have that kind of structural tightness in physical markets, the paper price eventually has to adjust upward to reflect reality. Investment demand is also returning after several years of decline. Physical coin and bar purchases have strengthened considerably in recent months. Exchange-traded product holdings, while they face some liquidation during the January volatility, remain near historically elevated levels at approximately 1.31 billion ounces. As Western investors who sat out the initial rally begin to recognize the magnitude of what's happening in silver, that investment demand could accelerate significantly. There's also a geopolitical dimension that's supporting silver's outperformance relative to gold. The export restrictions China implemented in January 2026, requiring licenses for silver exports and effectively limiting most of the country's production to domestic use, have created a bifurcation in global silver markets. China is the world's second largest silver producer, and by restricting exports, they're acknowledging that silver is a strategic material essential for their technological and industrial priorities. This has tightened global supply outside China even further and added a risk premium to prices that didn't exist before. When you layer all of these factors together, the supply deficits that keep widening, the industrial demand that keeps accelerating, the inventory drawdowns at major vaults, the geopolitical supply constraints, the return of investment demand, you have a setup that favors continued ratio compression. The move from 100 to 1 down to 57 to 1 was just the beginning of a revaluation process that has further to run. Now, predicting exactly where the ratio will bottom is impossible because markets don't move in straight lines, and there are countless variables at play. What we can say with confidence is that the historical pattern of mean reversion after extreme ratio readings suggests we haven't seen the end of silver's outperformance. Whether the ratio ultimately compresses to 50 to 1, 45 to 1, or even lower depends on factors including the trajectory of gold prices, the pace of industrial demand growth, the severity of physical supply constraints, and the magnitude of investment flows into silver. What's most important for investors to understand is that this ratio compression represents a fundamental repricing, not speculation or manipulation. Silver was genuinely cheap relative to gold when the ratio was above 100. As that imbalance corrects, silver is experiencing the kind of explosive percentage gains that only happen when markets are correcting extreme mispricings. The fact that this is happening while both gold and silver are in bull markets makes it even more significant. This isn't silver rallying because gold is weak. This is silver rallying harder than gold because its unique supply and demand fundamentals are finally being recognized and priced into the market. For investors, the implications are profound. If you're holding only gold as your precious metals allocation, you're missing the metal that's demonstrating superior relative strength and has more compelling supply and demand dynamics. If you're holding silver but questioning whether the move has run too far after the January peak and subsequent correction, the ratio analysis suggests there's substantial room for further gains, especially if you're taking a multi-year view. And if you're not holding any precious metals exposure, you're missing one of the most significant commodity repricing events of this decade. The gold to silver ratio is one of the oldest and most reliable indicators in commodity markets, precisely because it reflects the relative supply and demand fundamentals of two closely related but fundamentally different metals. When that ratio reaches extremes and begins to revert, it creates the kind of asymmetric opportunity that serious investors live for. We're in the middle of that reversion right now, and the evidence suggests we're still in the early to middle stages, not the late stage. Looking ahead, the factors that drove the ratio from 100 to 1 down to 57 to 1 are not dissipating. If anything, they're intensifying. Solar panel production is accelerating, not slowing. Electric vehicle adoption is growing, not contracting. Data center buildouts for artificial intelligence are expanding at extraordinary rates, not pausing. Mine supply remains constrained, with no significant new production coming online for years. Physical inventories continue to decline. Geopolitical supply risks are increasing, not decreasing. All of this suggests that silver's outperformance relative to gold has room to continue, which means further ratio compression is likely. Whether we see 50 to 1, 45 to 1, or even lower ratios will depend on how these various factors play out over the coming quarters. But the direction appears clear, and the magnitude of the opportunity remains substantial. This is why paying attention to the gold to silver ratio isn't just an academic exercise or a historical curiosity. It's a practical tool for understanding where value lies in precious metals markets and where the greatest potential for gains exists. Right now, that tool is sending a very clear signal. Silver is in the process of a historic revaluation relative to gold, driven by fundamental factors that are powerful, structural, and far from exhausted. Before we wrap up, I want to give you a preview of what's coming in our next video because it ties directly into everything we've discussed today. We're going to do a comprehensive breakdown of the physical silver shortage crisis that's developing at COMEX and the London Bullion Market Association. We're going to examine the specific numbers, the withdrawal rates from registered inventory, the open interest in March delivery contracts, and what happens if even a fraction of those contracts stand for delivery. This is the mechanism that could drive silver prices dramatically higher in a very short time frame, and it's something every precious metals investor needs to understand in detail. We'll be looking at the paper-to-physical ratio, the lease rate spikes, and what happened with previous delivery squeezes in other commodity markets. If you think what we covered today about the ratio compression was compelling, the physical delivery situation is going to absolutely blow your mind. So make sure you subscribe to the channel and hit that notification bell so you don't miss that video. The silver market is moving fast right now, and staying informed with accurate data and clear analysis is more important than ever. I'll see you in the next one where we dive deep into the delivery crisis that could reshape the entire silver market structure.